Imagine for a second that you're a capital markets authority policymaker. You are staring down the barrel of a rapid, massive, yet entirely invisible, informal crypto economy. Literally every single day, people are using stablecoins for remittances and everyday merchant payments. But here's the kicker. It's happening almost entirely off your regulatory radar. So how on earth do you regulate a multi-billion-dollar financial ecosystem that you can't even see?
Well, welcome to this explainer. Today, we're unpacking the Lipa-Pocket Sandbox proposal. Think of this as a master blueprint for taking those untraceable digital transactions and transforming them into a structured, visible financial infrastructure, one that actually works for and actively supports national economic goals.
Here's our quick roadmap for the explainer today. We're going to cover the digital dilemma, bridging fiat and crypto, agent networks, built-in risk management, real-time oversight, and we'll wrap up with the three-phase sandbox test.
All right, kicking things off with Section 1, the digital dilemma.
We've really got to start by acknowledging the elephant in the room. Right now, we have this huge, unrecorded, informal crypto economy. It's totally fragmented, it's invisible, and let's be honest, it carries a pretty high risk for financial crime. But if we can shift this activity into a regulated digital economy, we formalize it. And for a CMA policymaker, that is absolutely crucial because it provides the regulatory visibility needed to significantly lower overall systemic risk across the entire nation.
Moving right along to Section 2, bridging fiat and stablecoins. So how exactly does Lipa-Pocket translate complex blockchain tech into something that actually works alongside traditional fiat, like the Kenyan shilling? The secret sauce here is what's called a hybrid ledger model. This gives regulators a kind of best of both worlds scenario. You get the unalterable transparency of the blockchain, which is perfect for auditing, but you combine that with off-chain execution. That off-chain piece is what gives you the immediate low-cost scalability you literally have to have for high-volume everyday merchant payments.
And what's really brilliant here is how it simplifies the user experience, particularly for non-technical stakeholders. Users don't need to know the first thing about blockchain. It's super simple. A customer just scans a familiar QR code or uses a payable system. Then all that complex mapping and validation happens completely invisibly off-chain. Instantly, the merchant receives their settlement in either fiat or stablecoin. It totally bridges the gap without forcing anyone through a steep tech learning curve.
That brings us to Section 3. Driving inclusion and access. Now, any new infrastructure has to support national financial goals, right? And a massive one is extending access to underserved communities. Lipa-Pocket tackles this through a localized agent network model. By setting up these networks with strict, managed float limits, the platform creates super easy cash-to-crypto on-ramps and crypto-to-cash off-ramps. It's a game changer because it takes informal, cash-based economic activity and formalizes it, extending real financial inclusion right down to the grassroots level, even in areas where traditional banks just don't operate.
But you might be wondering, how do you handle identity verification when folks might not have a ton of official documentation? Well, to ensure consumer protection, they've designed a tiered KYC model that actually adapts to the reality on the ground. So a low-tier account might just need basic ID and a phone number, but it comes with strict transaction limits. Then, if you want higher limits, high-tier and business accounts require enhanced due diligence and full KYB, or Know Your Business, verification. It's a really pragmatic way to enforce KYC protocols without accidentally locking vulnerable people out of the economy.
Let's pivot over to Section 4, built-in risk management. Look, bringing crypto into the light is great, but it means our technical safeguards against platform failures and market volatility have to be ironclad. For instance, to tackle custodial wallet risk, the platform uses multi-party computation, or MPC, alongside multi-signature protocols. Basically, this means no single person or entity holds the keys to the funds. To prevent the whole system from crashing during high transaction volumes, they rely on rigorous stress testing and that off-chain processing we talked about. And during times of market stress, liquidity risks are handled by real-time pricing engines and automated treasury rebalancing. This ensures there's always verifiable stablecoin reserve transparency, allowing for rapid, safe conversion back to local currency when things get bumpy.
Which leads us perfectly into Section 5, real-time regulatory oversight.
The internal security is solid for sure, but the real goldmine for a CMA policymaker is how this system continuously feeds data back to the authorities. By fully committing to international FATF, Financial Action Task Force standards, the embedded anti-money laundering controls are completely next level. We're talking real-time dynamic risk scoring for transactions, automated international sanction screening, and built-in suspicious activity reporting workflows. It literally takes the blindfold off the regulators. Plus, there's a highly secure API integration layer in the architecture. It uses encrypted TLS data exchange and OAuth 2 authentication to seamlessly talk to external banking institutions. For regulators, this means you get live real-time dashboards to monitor systemic risks and actually track cross-border capital flows. And because of how the platform architecture is built, it natively enables cross-border interoperability, setting the stage for future expansion into broader regional markets in a totally safe and visible way.
All right, down to our final stretch. Section 6, the three-phase sandbox test. So the tech is sound, the oversight is clear, but how do we actually deploy this massive shift without breaking our current financial system? We do it progressively. This three-phase sandbox timeline is designed to foster innovation, but prioritize consumer protection at every single stage. Phase 1 is an 8 to 12-week, highly restricted internal pilot, purely focused on system stress testing. Phase 2 opens up for 12 to 16 weeks as a limited public pilot, testing merchant acceptance and fiat conversion. Finally, Phase 3 tests the heavy hitters, like cross-border interoperability, under heavily enhanced supervision.
Because you see, the endgame of this sandbox isn't just to pat ourselves on the back for a successful tech demo. The goal is to generate hard, empirical data. That data is exactly what's needed to establish a fully formalized authorized virtual asset service provider, or VASP, framework for the nation. It gives regulators the power to write the rules of the road based on actual, observable market behavior, rather than just guessing.
So if there's just one thing you take away from this explainer, let it be this. Regulating stablecoin infrastructure isn't just about policing some fancy new technology. It is fundamentally about providing the visibility necessary to safeguard our entire economic future. By taking those invisible, fragmented transactions and putting them into a transparent, structured system, policymakers can finally get a grip on and actively reduce overall systemic risk. The invisible digital economy is already here, churning away in the dark. The only question now is, how quickly are we going to bring it into the light?